Hello, YouTubers, friends, compatriots, bootlickers, shills, desolators, peasants, vassals. I'm a useful idiot. Today I want to talk about the Federal Reserve and their exit strategy. And it's been notable for the last 4 or 5 years that the Federal Reserve hasn't had an exit strategy. And now apparently the Congress itself is a little concerned about what the Federal Reserve's exit strategy is, as are some board members of the Federal Reserve. And well, they should be. Because as it turns out, the Federal Reserve has a record balance sheet now, $3 trillion. And most of that is toxic assets, mortgage-backed securities, and all that crap they've taken off the hands of the banks. And then, of course, they're one of the only buyers of U.S. Treasuries right now as well. In the last 2 rounds of QE alone, they bought $540 billion in U.S. Treasuries. But where it gets interesting is what is the exit strategy? Are they going to try and hang on to these toxic assets and hope that someday they're worth something and that they can make some money off them? Or are they going to try and unload them as quickly as possible and just take a loss on them? So that's a question for another day. But what we do know is that the Fed is between a rock and a hard place. They really can't raise interest rates without wreaking all kinds of economic havoc, as that interest rate passes on costs throughout the entire global economy. But at some point, they will have to raise the interest rates, and the market will force that hand. The market will make sure that interest rates rise because they have to. But here's where it gets interesting, because if the Federal Reserve, say, rose the interest rate from its current 0.25% to, say, 2.0%, that would be enough to shake the rafters. And on the plus side, of course, we'd have a lot of depositors and savers who would be getting more interest on their accounts. But some of those depositors and savers would be the too big to fail banks. As it turns out, because of the economic collapse, the Federal Reserve basically had all the too big to fail banks park their reserves at the Federal Reserve and get interest on them. So it, like I said before, it isn't that much, 0.25%, but still, that's free money that the banks are getting just by parking their reserves at the Fed. So they get a little trickle of free money from the Fed for like the last 4 or 5 years. And Wells Fargo has nearly $100 billion in deposit at the Fed. J.P. Morgan has near $90 billion. Goldman Sachs has $60 billion. And we even have a lot of foreign banks that have parked their reserves there and are getting interest. Canada's TD Bank has $12 billion or more deposited there. Deutsche Bank has $12 billion or more. UBS has $12 billion or more. All parked at the Federal Reserve, all getting interest. But here's the kicker. If the Federal Reserve bumps up the interest rate to, say, 2%, then they will be paying those banks, those too big to fail banks, $50 to $75 billion a year in interest. And granted, the banks will have some added costs, as they will be paying higher interest on their loans and passing that on. But the fact is that there will be a huge final giant bailout of the banks, including these foreign banks, if the interest rate goes up. So the banks would be splitting $50 to $75 billion a year in interest from the Federal Reserve. And that's more than a lot of their profits through their business activities. So there it is. The Federal Reserve's exit strategy will include one big final giant bailout for all the too big to fail banks. How ironic. I'm a useful idiot. Don't you be one too.